Hello, ladies and gentlemen, and welcome back. Well, hopefully some of you out there heeded our warnings about this inflation number. Yes, it was brutal and the market sold off, and you can see the damage here. Microsoft, Apple, Google, Amazon, all the big ones, and it was just a red sea across the board. The inflation looks to be sticky. We've talked about this for a while, and this has sent some really big shockwaves through the bonds market that we need to discuss urgently today. The other thing that we need to talk about is what happens after such a massive event. Well, we've got that and more today in the video, so stay tuned as we go through everything you need to know about all the markets around the world right now. See you soon. Well, welcome back everybody to the channel where we discuss stocks, commodities, and cryptos daily. The biggest Fed fund hike rate in 40 years. Are we about to see that next week? Yeah, it doesn't get more exciting or more potentially scary than this. 100 basis points is what people think could happen, or at least economists think. 75 seems like almost the consensus now, and we are moving into this 100 basis point kind of thought process. What does that mean for markets? Well, it could mean more pain is to come, and of course with that flash crash that we saw realistically before the market with the core inflation being so sticky, we now have over 4 handles across the board in 2023. That means that 4 plus, even 4.3% almost, is being expected by March into April of 2023. Global fund managers, what are they doing? Are they over or underweight to equities? Well, they've just equaled a new record, or actually gone underneath it. Record low underweight to equities, surpassing September 2008 lows. Now, the interesting thing about this is we're getting to that point where there's so much bearishness in this market and so many people that are heavily bearish. Do we need to pay attention to that? Yes, it was terrifying what we saw with the flash crash of the last 24 hours. Yes, we might make new lows. Yes, we could be coming back to a point that we've discussed so many times now over the last month to 2 months, and that is a double dip in this market. But you still have to keep your eyes open to both possible scenarios. So what are large traders doing right now? Well, of course, we know they're spending huge amounts of money on puts relative to any other strategy in the market. This is now, again, a record high. 2022 filled with records. Look at this. Absolutely just going well above any other time that we've ever seen. Now, when we've seen things like this and we see large traders spending record amounts on puts relative to calls, what types of readings have we seen? Well, here's the problem. We don't have too many data points. But you'll notice that the data points we do have, which is, of course, now, we also had a little bit of sideways market back here in 2016 when we got a reading similar to this. And then there was 2008. And look what happened. It sideways, went down, and then went into capitulation. This is something that a lot of traders are going to be looking for in 2022, possibly even 2023. Most bear markets end in capitulation. That is incredible fear selling. So we'll be talking about that more when we get into the charts soon, so stick around. But this is a big thing that we need to be considering. So where is the inflation? Where is it not? Well, of course, we know that we saw a huge amount of inflation in energy. Now it's going into airfares. Airfares are up across the board. I'm from Australia. I can definitely tell you that it is all up. Of course, America, much more expensive. But the big thing is sticky inflation. The things that people are really bringing into is, of course, rents. We're seeing rents getting a little bit out of control. That's rising at a very fast rate. And food. And the market is only really buying those types of stocks. If you look at the last 24 hours in the market, we saw a huge strength in, of course, well, not huge strength, but a little bit of a pickup in some of those sectors, the sectors where inflation was really getting out of control, which of course could potentially make those companies a little bit more money. S&P 500 index averages year-to-date return. We know this. This is September, one of the worst times of the year to be in the markets. Midterm election years as well. Remember, we're not even talking about that yet in the US. That usually is what leads onto this instability. Generally, September back end, October become that kind of really brutal kind of field of big amounts of selling, and then we often do get a recovery point. Now, this is a year like no other. 2022 is, of course, very, very sketchy, but if things are to hold, we expect weakness into that September, October period, and then potentially even a bounce which a lot of people may not expect, especially when things look really dire, and they could look really bad soon. Late September is where the trouble tends to arrive. Here's just another chart so you can see from 1950s all the way to 2021 data. And the reason why we've been kind of calling this idea of the double dip has got to do with correlation. And a lot of it has to also deal with what the bonds market is telling us. Whenever the bonds, all of them have inverted, everyone here on the channel knows if you've been watching for a while, when we've gone over 50%, you have to pay attention. It generally means we're in a US recession. And whenever we're in a US recession, certain correlations are worth paying attention to. Over 50%, it's coming, whatever that meaning means right now. Of course, they change it all the time, but realistically, a sickness is in the markets. And I think we're all very aware of that, especially after the last 24 hours. So what happens here in bear markets, what in terms of recoveries, in terms of sell-offs and everything, if you're interested, you can pause the video at this chart. It's good, just a little bit of data in terms of how low we could go. One of the case scenarios that a lot of people have is around 3,200 on the S&P 500. A lot of people are going to be talking about that again now. Yes, that is a kind of average kind of case scenario here. We don't know that's going to happen yet, but of course, if we make new lows over the next coming weeks, you might want to come back and check out that chart. What are the most correlated markets at the moment to, of course, what we're seeing? Well, of course, we've got that 1962 market, 2008, and 1973 are the big kind of cases. Now, in the bull scenario, we end up double dipping and then rally. That would put us down to around that 3750 kind of area on the S&P. In the really bear case scenarios, we make new lows, and that's where things can get very dangerous. Look at that 73 in 2008. In all cases, there were recessions in the market, so that's going to be very, very important, except for this one down here. So we do know that the bonds market said so. That makes the case of pulling back very likely. And of course, that's what we've been really discussing here ever since we hit those 4,300 plus handles on the SPY only, well, literally a month ago now up to this point. So what happened in this market? Why is it so freaked out? Well, of course, the inflation number, but also when we go down 4+% and the NASDAQ over 5%, what do we expect next? Well, statistics would have it us to believe that, of course, the market would bounce. Usually when you see such huge sell-offs, you do get a little bit of reprieve. That doesn't mean it's a good amount of reprieve. It just means that statistically the market slightly bounces the next day. I've seen it bounce during these times 0.3%, 0.7%. Usually the weaker the bounce, there's usually a lot more selling to come. You've got to be very, very careful about this. And you'll notice that if we take a look at the sectors, the market was beating all of the growth sectors in the last 24 hours. We've got biotech, consumer discretionary, technology, communications, and semiconductors all down and hit hard. So before we jump any further into the key levels that we need to be looking at in the market, I wanted to thank the sponsor of today's video, which is Tiger Brokers. We're doing a special 3-part series going through some of my favorite features that Tiger Brokers platform offers you guys out there, the traders and investors in the community. The first one is, of course, being able to access timely information. And what better time to, of course, create a video like this with that inflation number that just came out. Tiger Brokers has a whole bunch of premium services in terms of premium news feeds, and you can go check them out in the link. But also there's a whole bunch of really good features that they offer on top of things like important news announcements coming in a feed over here, and a synopsis of course, the articles themselves. You can see here the inflation number coming out, the Bloomberg article here, persistent price pressures, underlying picture, being able to open that and potentially zoom into it or enlarge it if you'd like to. And it's just nice to have all of the information in one platform without you having to go to all the websites and check those things out. We've also got a great calendar report. Over here on the left-hand side, you'll notice that you can select the day that you're looking at. You can select the type of news event that you're looking for in terms of dividends, IPOs, or report announcements, and even the markets that you're interested in. Let's say you trade the Australian market and the US market, you can select that, or the Hong Kong, Singapore, etc. And they're adding more all the time. And this is something I love to use during reports earnings season. And specifically, I like to use weekly over the daily and monthly view. I just think it's awesome to be able to view whichever way you want to. Customization is a big key in any platform, and Tiger Brokers really do offer that. Stay tuned for some of our other videos we'll be doing where we're looking at some of the other cool features. But if you want to check out Tiger Brokers' special offers to the community, look in the link description down below. They have a whole bunch of special offers for you guys out there. Let's talk about the VIX. So why could we be potentially considering maybe a small bounce over the next 24 to 48 hours? The only reason you would say so is because when you get over 10% on the VIX, which we did, 14% plus, you do have a bit of statistical, usually bounce in the market over the next day to 2 days. It doesn't mean it's a big bounce. It doesn't even mean it's tradable, but you can sometimes expect it if it hits around a level of support or resistance that is critical. We'll take a look at that soon. This is where things get really interesting. US 2-year, take a look at this, 3.75%. It's been going up and up and up, and so has the market in the last couple of weeks. And we saw that market sell off, pull back up, and at the same time, yield was rising. This was a good precursor to the market falling back off, and that's exactly what happened. 3.7, but what's more disturbing is probably when we go out and look at next year. So if we go now to April, 4.32%. If you go over to our Twitter handle at FX Evolution, you'll see a more detailed chart showing all of the expected dot points going through past 2023. And you'll notice it still looks like this, guys. It still looks like a hike, cut, and then stabilization. The cut is not very big though anymore. So sticky inflation is what the bonds market is expecting. And you know what? I always go with the bonds market over the tabloids out there. But it's always important to understand what they're telling us. And they're telling us 4.3% expectation now for 2023. Let's move over to the US dollar. How did it like it? Well, of course, strength. Coming off that level that we discussed in the last video, the support level, we really needed a new low after here to predict something like this going on. It didn't happen. In this case, we realistically just had a very nice kind of level that was end up being demand. It was at a key support. This level here held, the news came out, and it just went gangbusters up. Would you trade the dollar from here? Probably not. The problem is sometimes this news is that you don't get much technical structure. Look at this, just boom, and it just goes straight back up. You're at a point now, which is kind of a zone where you could expect a little bit of a pullback, maybe back into this level here, about 109. So you got to be very, very careful with the US dollar right now. A lot of strength in it. No doubt it came off a good level. It does love higher yields. Of course, that strengthens cash usually in this case because it becomes more desirable. Putting cash in the bank just makes sense here if you don't understand the economics too much. And this is, a flight to safety. That's really what it is. Gold held pretty well considering. Now, it is going to get battered around if US dollar continues to go up. It's at the level of support we've been discussing, this 1700 zone. It continues to make a series of higher lows on this higher time frame. But when we go into things like the 1 hour, it was a pretty nasty sell-off. Of course, we saw this level get taken here, which you would have hoped some buyers would be able to come into. But there was many strong kind of reasons why this had to go down. Such big strength in the US dollar. Also, gold hates inflation. And let's face it, this is going to a new high in the inflation numbers. So gold for now, sitting on support, no current trades or any real action here at this level. This is where you think buyers will come back in, but you have to practice patience and react to this. And we don't have any realistic signals just yet to go to the long again on the smaller time frames. The oil trade is the same. It did okay after the announcement, but realistically stuck pretty much to its guns. You can see here we have a resistance through the 90. I'd like to see that get taken, a little bit of a pullback, and then movement up. Some people call this an inverse head and shoulders, forming left shoulder, head, right shoulder. Look, if inflation really is going to stick around, possibly oil does well, but you guys know if you've been following the channel for a while, I have a negative kind of feeling on oil here, and I believe oil can move down all the way into this zone over the next coming months as demand does get hit by no doubt a very high interest rate number across the world. I think that's really going to take a big hit to a lot of airline companies. It's going to also smash around a few other players out there, of course, as well. Let's move over to Tesla. What happened there? Well, the pre-market hit the level. It hit the zone we've been discussing for a while. We saw pre-market strength. We probably got around a 307. And then by the time market opened, it would already sold off heavily because what happened was we got the inflation number 1 hour before. If you don't have access to futures markets, this is sometimes where it does pay to have that pre-market kind of thing. News coming out 1 hour before. The Fed is data driven. Obviously, Tiger Brokers, the sponsor of today's video, do have this, so it's always worthwhile checking them out. And you'll notice that this is why it's important, because you may have had to have closed before the number. You get this kind of level, but then by the time the market's open, you get the wrong level. So sometimes it does pay to have that kind of access to the futures market. We'll see here that there still hasn't filled the gap that sits around this 289. I don't think Tesla is really leading this market. Obviously, it's the rest of the things and the stocks. And the one I'm looking at is actually Apple, because Apple did fill the gap. It also came straight back down into this super key level. Now, let's just think about this. The market is swinging lower at this stage. It's back into support for now. What happens if it dumps through this level? Do we then go on to make and really test back down here in the June, July lows? Well, that seems like a very big possibility. Of course, we do expect potential here of some strength, like a little bit of a bounce, and then possibly sell off after that because of everything we'll talk about in options just a few moments. But yeah, Apple is looking quite weak. And this is across the board. There's a few stocks that look like this. If you look at Amazon, again, new low could be forming very, very soon. It's left behind now some pretty chunky gaps that could be filled. You never know. And then we go through here to Google. Of course, Google, look at this, guys. Absolutely on its knees. It's sitting on the support. Could these big stocks, these big FANG style stocks, be telling us something we don't necessarily want to hear, or a lot of you may want to hear out there if you've been following the channel for a while? Is there more bearishness to come? Look at that, right back on the support or the big key levels. If we move over now to bonds, what are they telling us? Well, high yield bonds did not like this core inflation result. We talked about the series of lower highs in comparison to the stock market in the previous video. Go check it out if you haven't already and skip to the bond section. And if this makes a new low, it could spell some real problems for the stock market. Now, there are two things to be considered here. The way I look at bonds is not the same as everybody else. Of course, you have to expect bonds not to like increasing rates. That's just the way they are if you understand bonds. But at the same time, there is a weakness here that's larger than just the inflation, just the yields going up. So series of lower highs, not good, and still points towards that serious weakness potentially coming through. For the bulls, though, where is the good case scenarios? Well, it's mostly in ratios. XLY versus consumer staples. We're seeing it hold pretty well. Now, for anyone who's been following the channel for a while, we know that we use this indicator to show us risk on, risk off. In general, we are not necessarily seeing a huge sell-off in the risk assets in comparison to the defensive assets, not like we saw all of 2022. We'll keep updating this chart, and it's something to be looking at. Another one that we want to look at is something like QQQ versus the SPY, because as you'll note, if you go to a log chart here and you look back over the history of this ratio, it's at a very critical level. Look at this support. Wow, it's huge. So this will be something that a lot of people are going to be looking at, and we'll bring this up on another video to discuss it in more detail and what this ratio really means for the market. But yeah, big zones here. Very important what happens over the next 1 to 2 months. We've got here the DAX, huge trend line for any of our European traders out there. This is going to be very nice trade, actually. That trend line's been holding. We brought this up on the channel quite a while ago. We started talking about it realistically in here. We talked about the ramp. We talked about the sell-off. And then we get another one. It's just about, well, we don't know what's going to close as the weekly, but it looks like a shooting star at this stage. And if we go over here, we've got a big engulfing bearish candle back into some structure. You guys all know where the real problems lie. 12,450. Get underneath that. Well, watch out down below, because the next level we go to could be something like an 11,500 on the DAX. We've got to keep an open mind to that possible scenario. Here's the NASDAQ. Take a look at this 1 hour. Look at the gap. There's the close. There's the close. Straight back into support. Huge gap left. Will we fill it? We filled this one in the previous session. Could we do something like this? It is possible, and you've got to keep an open mind to it. But I think the most important thing is to have a look at some of the bigger sell-offs that we've seen in recent months. If we go over to the NASDAQ, the big issue with it is we saw this one, which is going to be in everybody's mind, a brutalized sell-off in the markets. Sell, gap on the weekend, and it was just selling. It was really wild. And that was a very brutal sell-off. Could we get a new low here? If we do, where do we stop? Do we go all the way back down to these lows? It seems likely that we'd go back into these levels down here should we get a new low forming on this market. But at the same time, we have to be open to this idea of the next 24 to 48 hours. And the reason is quadruple witching. There's so many options expiring this week and so many games that could be played. At support, it's going to be very tough to go short here. And it's going to be very tough as well to potentially go long. Sometimes having the patience to just chill, celebrate maybe if you've had a good trade, if you did kind of focus on these levels that we discussed and get a bit of a short in, get a little bit of a long in. This was an occasion where, we were pretty much right on those levels, which was fantastic. And now you've got to say, well, maybe we need to have the patience to wait for the next information. Let's see what the rally looks like. What if it comes back up here? Would you want to sell it if it fills that gap? Potentially. So there's a lot of things to play here, and the S&P 500 will be the best guide for this. You can really clearly see where that next level of demand would be in this market, that 3,800 to 3,750 zone on the SPY. This is going to be a super important one. There's the volume. Yes, it was elevated. It wasn't insane. But remember, again, big market action. We had a close to an open to another close of 4.38%. At one point, we were down 4.6% on the session. We took off everything we put on the last week. We left gaps. That's only part of the story. We're back at the support. And you'll notice that when we've had these types of big sell-offs, often we've started to structure up afterwards. We have these big sell-offs and we do structure up. There are some occasions where it just basically keeps going down. But even here, where it went down, we still structured up. Here was the big sell-off. None of these days, though, even though there was so much bigness here, most of these days realistically weren't like this one here. They were a little bit different. So we'll be paying attention. We're at support. The futures market is really going to help us out a lot. This was where we thought the resistance would be and the sell-off would occur, 41.30 to that 41.60 zone. We ended up hitting 41.54 in the futures market and then sold straight off. If you use ES, it'd be a little bit different. So if we load up ES here, and the S&P 500 minis, you'll notice it hit 41.70, those previous highs. So actually ES was probably the best signal in all of the futures markets. If we move over to where we're at right now, back into the support structure, realistically sitting right on it. Depending on what it does here, stay tuned on the channel. We'll get a good idea of the next move. Very aggressive, sometimes difficult to trade past that aggressive kind of move. This is the support. Do we find buyers? Do they push above 4,000 again and structure up to fill the gap? This is something we'll be looking for. Of course, we'll also be open to the new low, retrace, and then short off that zone. Something that we wouldn't mind doing. Either way, there's a lot of opportunity still in these markets. Let's now move over to maximum pain. And this is, of course, looking at the futures market. We'll load this up because once we start loading the 16th, it's going to make more sense. Maximum pain is at 405. Current market, 393. Look at all these puts. This is a huge one. We've got 4.8 million open interest amount. You've got big spikes here. We know for sure that there is a 370 huge put wall. We also have a 400 huge put wall. So will the market retrace by Friday to try to get into this area? This seems like a possibility and certainly something that a lot of people are going to be looking for on this market. Maximum pain usually works best in the third week expiration. Of course, there are big forces at work. Never rely on maximum pain itself, but you've got the 390 put wall and you've got this interesting 400 point. So that's going to be something that I think a lot of people are watching. Max pain at 405, 400 puts, becoming one of those big kind of zones. See how this eventuates over the next couple of trade sessions, and we'll find out whether we can actually rebound back to this level to close the week. Let's move over to the crypto market. This was actually almost perfection. It hit that level, that zone we talked about, very similar to the stock market. You can see how they connected and then just boom, big sell-off. Almost $3,000 on Bitcoin pretty much straight away. It's come back into a good level of structure. This is a nice little level of structure. Again, it would be consistent with finding some buyers here. Aggressive sell-off, big volumes, of course, this is the area. If buyers are going to come back in, they're going to show some commitment here. Now, that doesn't mean you have to freak out if you're a seller, but you've got to be open to the idea that the market may bounce this level. It's more statistically likely than not if you look at the charts and you consider it. Of course, for Bitcoin bears, where will you celebrate? Get underneath 17,500. Yeah, I'm thinking potentially 9 to 11,000 is very open for Bitcoin, and it would be consistent with what we've been saying here on the channel for a long time. I would like to see, and I know that seems weird, but 9 to 11,000 happen sometime in the next 100 days. And that would be very consistent with what crypto does over time. If you haven't already, come and follow us at FX Evolution on Twitter. Of course, join our Discord community as well. And you can join our public or private Discord. So many people in the private Discord did pretty well this week. Come and join us if you're interested, and check out our daily write-ups and everything else we do, including the live videos. And if you're not aware, there's still more news to come. Of course, we had realistically just the first one. We had the inflation number, that's 0.6% here on the core, which is what everyone's concerned about. Then we had the PPI number coming out 8:30 a.m. New York time for the Wednesday. Then the Thursday, we've got core retail sales, another big number. So if bears are going to come in, maybe it's all data driven. The Fed's data driven right now. This stuff is all very, very scary for, of course, the bulls out there. How will it go? We'll have to find out. A big thank you to today's sponsor of the video, which is, of course, Tiger Brokers. If you're interested in finding out any more about what they offer the community, you can check on the links down in the description. There's a whole bunch of different special offers for all of you out there in most of the countries that are watching. Have a great day. And of course, make sure you practice patience and risk management in times like this. The market is going to be wild, potentially now even for another year. So stay tuned, subscribe, and we'll see you in the next one.